This is Professor Dean Mead for Advanced Topics in Governmental Accounting at the Rutgers Business School, and this lecture is on the accounting and reporting of deferrals under GASB Statements 63 and 65, as well as several other statements that require the reporting of deferrals. I'm going to begin with a background on Statements 63 and 65, some kind of explanation for you of why it is the board felt that it needed to put out these two statements, and then get into talking about deferrals themselves, what they are, and then what specifically is required by Statements 63 and 65. So beginning with the background and rationale, when GASB issued Concept Statement number 4, Elements of Financial Statements, it identified assets, liabilities, inflows and outflows of resources, net position as the bottom line difference between assets and liabilities, as well as two other statement of financial position elements: deferred outflows of resources and deferred inflows of resources. Those were a bit of a surprise to some people. They were not expecting, I think, that there would be two elements that they had never heard of before being codified essentially in the GASB's concepts, saying that in addition to assets and liabilities, there are other items in a statement of financial position that don't meet the definition of an asset or a liability, but they're still there. So they must be something else. And what the board determined they were what they called deferred outflows of resources and deferred inflows of resources. Now, this differs from what GASB Statement 34, which lays out the financial reporting model, requires for presentation in a statement of financial position, which is assets, liabilities, and net assets, or in the case of the governmental fund financial statements balance sheet, assets, liabilities, and fund balance. So there was a basic need here, obviously, to provide some guidance on how to report these things, but maybe it wouldn't have happened when it did if it weren't for the fact that the board was at the same time developing standards for reporting derivatives, derivative instruments, and what are called service concession arrangements, or long-term agreements in which a government turns over the operations of a major piece of infrastructure like a toll road to a private operator, or sometimes even another government, and in exchange it receives payment. And there are some very specific criteria in Statement 60 that distinguish service concession arrangements from other types of leases and contracts. But in each of these, the board was considering the reporting of deferrals as a part of the accounting for these transactions. With derivatives, what the board had proposed and then ultimately required in Statement 53 is that if a derivative instrument, is effectively hedging either the cash flows or the changes in fair values that it was entered into to hedge, then year-to-year changes in the fair value of that derivative instrument, rather than being reported as investment income, would be reported as deferred inflows or deferred outflows of resources. And then when the derivative instrument reached the end of its life, when it matures, at that point it will have returned to a zero fair value. It begins at zero, it ends at zero, and so those deferrals would be wiped out. And in so doing, if the deferral works the way it's supposed to work, you don't end up reporting any increases or decreases in fair value during its life, and thereby, potentially overstate or understate investment income. If those derivative instruments, however, during the course of their lifetime before their maturity, cease to be effective or are terminated for any variety of reasons, at that point, what has been accumulated in the deferred inflows or deferred outflows then runs through investment income in the period in which the termination or ineffectiveness occurs, and then in subsequent periods, any change in fair value is run through the income statement, just as if it were an investment. For Statement 60 with service concession arrangements, these usually involve very large upfront payments from the operator to the government. And what Statement 60 requires is that upfront payment be recognized initially as a deferred inflow of resources, and then beginning in that first period and in a systematic and rational manner over the term of the service concession arrangement be recognized as revenue in each year. GASB also was working on its pension standards at this time and had proposed and ultimately then required in Statements 67 and 68, and then in 73, 74, and 75 when it took on OPEB, as you learned in the first unit, to defer certain of the changes in the net pension liability from period to period and report those in pension expense or OPEB expense, as the case may be, over a certain period, either the average remaining service period of the members of the plan or a 5-year closed period. So obviously there's a question here that if GASB is requiring these to be reported, but Statement 34 doesn't provide any guidance as to where they're supposed to be reported, constituents wanted to know, so what do we do with these? And the staff in trying to answer these questions was in a bind because they couldn't say put them in their own section because there was no provision for that in the standards, but they also couldn't say continue to report it as with the assets and liabilities because they're not assets and liabilities. The board knew when it issued Concept Statement 4 that this would become an issue, and so it stated very clearly that governments should only report deferrals that are specifically required by the accounting standards in order to avoid governments, essentially trying to apply the definitions of deferrals on their own, and therefore ending up with a lot of incomparability from government to government because one government might apply the definition differently or one government might not apply any definition at all and just continue to report those things as assets and liabilities. So before getting to the definition, let me just say very quickly, and we'll come back to this in more detail later, Statement 63 is the answer to that question, where do we report deferrals? And Statement 65 is the answer to the question, well, of these things that we've been reporting as assets and liabilities all these years, which ones are really deferred inflows and deferred outflows? So let's take a step back now for a second and answer the question of what deferrals are. Part of the reason why these are sometimes confusing to people is the name. Deferred outflow of resources, deferred inflow of resources sounds like what has been deferred is the outflow or inflow of resources, and that's actually not at all true. Like inflows and outflows that are reported immediately as revenues and expenses, deferred inflows and deferred outflows are inflows and outflows that have already happened. But what is deferred is the recognition of them as revenues and expenses or expenditures on the modified accrual basis. An inflow of resources is an acquisition of net assets applicable to the period in which it occurs, as opposed to a deferred inflow of resources, which again is an acquisition of net assets, but it's not applicable to the period it occurred in. It's applicable to a future period, and it's in that future period when the revenue will be recognized. And likewise, a deferred outflow of resources, a current period outflow of resources is a consumption of net assets that has occurred in this period and relates to this period, so it will be reported as expense or expenditure, or possibly a loss, depending upon its nature. And then a deferred outflow of resources is a consumption of net assets that has happened in this period, but it's related to a future period. And in that future period, that's when it will be recognized as expense or expenditure. The accounting equation in governmental financial statements used to be assets minus liabilities equals net assets, or assets equals liabilities plus fund balance. Now with the deferrals in here, the deferred outflows have a debit balance like assets, liabilities have a credit balance like liabilities, so assets plus deferred outflows minus liabilities minus deferred inflows equals net position. And on the governmental funds balance sheet, assets plus deferred outflows equals liabilities plus deferred inflows plus fund balance. Statement 63 is the pronouncement then that says where in the financial statements these deferrals should be reported. Basically, what they say is that they should be reported in their own section on the statement of financial position. So you have an asset section with total assets, deferred outflows of resources with a total for those, liabilities, total liabilities, all the deferred inflows, total deferred inflows, and then net position. That's the same in the balance sheet too, although some of the subtotals will appear in a different place. Governments are allowed to present subtotals for assets and deferred outflows or liabilities and deferred inflows as long as they have presented them in their own sections and totaled each of those sections, so it's clear that they're separate things. They might just want to put those subtotals in, to help the reader more clearly understand how net position is arrived at. And in the case of the balance sheet arrangement, where assets and deferred outflows are on the opposite side of the equal sign, you end up having a total of assets and deferred outflows anyway, just because of the way the statement is set up. Net position has exactly the same components as net assets do under Statement 34, but the name of the first one, which used to be called invested in capital assets, net of related debt, is now called something that's a little bit easier to say, net investment in capital assets, but it's calculated exactly the same way. The book value of the government's capital assets minus any debt associated with the purchase or construction or reconstruction of those capital assets, and then restricted and unrestricted. Same exact categories, just a slightly different name to the first component of net position. So you can see here in a sample statement of net position, the deferred outflows of resources are in their own section, apart from the total assets and with their own total. And then deferred inflows of resources are in their own section as well, separate from the liabilities, and again with their own title. This government has not chosen to subtotal liabilities and deferred inflows or assets and deferred outflows. Sometimes you may not see the detail like we just saw in that sample statement of net position with the types of deferred outflows and types of deferred inflows, like the types of assets and liabilities. And if that's the case, there will be a note disclosure in the notes to the financial statements that will show you the detail below the deferred outflow of resources and the deferred inflow of resources, and it might look something like this. So in that first example we saw, this was essentially displayed on the face of the financial statements. In this case, they've decided to take the option of presenting it in the aggregate on the face and then presenting the detail in the notes to the financial statements. Here is the net position section for another sample statement of net position, and as you can see, it looks just like what you would have seen in a statement of net assets prior to the implementation of Statement 63. There are some disclosures, not very many, that are introduced by Statement 63. And the first one is what I was just talking about. If they're aggregated on the face of the financial statements, the detail is presented in the notes. And then if there's an amount that's reported for a component of net position and it is significantly affected by deferred inflows or outflows, then government should disclose an explanation of the nature of that effect on net position in the notes to the financial statements. So Statement 65 represents the results of the board going through every single asset and liability balance required under existing standards to be reported on the face of the financial statements, and ask the question, are these things really assets and liabilities? Do they meet the definition of an asset or a liability? Or, do they meet the definition of a deferred outflow or a deferred inflow of resources? Interestingly, when the board went through this process, it discovered that certain things that were assets and liabilities weren't assets and liabilities, also did not meet the definition of a deferred outflow or a deferred inflow. They actually were current period inflows and outflows of resources. They should have been reported all along, really, as revenues or expenses or expenditures. So basically, the board, followed this procedure, this hierarchy, or this series of questions, and it now actually follows this same procedure when it's doing any other pronouncement, and asking, what results from the accounting for a particular transaction. They will first ask, does the item meet the definition of an asset or a liability? If not, does it meet the definition of a deferred inflow or a deferred outflow of resources? And if not, then it must be a current period inflow or outflow of resources. Just to remind you, an asset is a resource that has present service capacity that the government presently controls. A liability is a present obligation to sacrifice resources that the government has little or no discretion to avoid. And as I mentioned a little bit earlier, outflows of resources are consumptions of net assets, inflows of resources are acquisitions of net assets, and they're applicable to the reporting period, as opposed to the deferred ones that are applicable to future periods. So the potential outcomes for things that were already reported as assets, either they continue to be reported as assets, or they would now be reported as a deferred outflow of resources or a current period outflow of resources. And for liabilities, they would continue to be reported as liabilities, or from now on, reported as a deferred inflow of resources or a current period inflow of resources. Now, I'm going to go through some of the examples of the changes and some things that were affirmed as assets and liabilities. The slides that go with this presentation go through them in much more detail. I'm not going to go through every single one of them because many of them, frankly, don't happen all that often for most governments. But I'll talk about the most common ones for you. One of them is imposed non-exchange transactions. What we're talking about here, for the most part, is property tax revenues. And property tax revenues, generally they're levied, they're collected, and they're almost always reported as revenue. However, if they are received or recognized as receivables before the period for which the taxes are levied, then they should be reported as a deferred inflow until that period arrives. So, for instance, a government may levy its property taxes for the fiscal year beginning July 1 in May, and it doesn't yet have a legally enforceable claim on those property taxes. That won't happen until July 1, when the fiscal year begins. But it sends out the bills in May and starts to get payments in June. So what does it do with those inflows of resources, that cash that it receives on those property tax bills for next year? You don't want it to report it as revenue right now, because that would overstate this year's revenue and understate next year's revenue. So instead, the government would report it as a deferred inflow of resources, and then when the next period begins, it would eliminate that deferred inflow of resources and report it as revenue then. It would also be able to recognize the portion that it hasn't yet received in payments as a receivable at that point, and the rest of the revenue, because that's when it has a legally enforceable claim. For governmental grants, government mandated and voluntary non-exchange transactions, most of the time, the vast majority of the time, they're expenditure driven, which means that the government spends first and then gets the reimbursement later from the state or federal government. So it will spend on a program, and that qualifies it to receive the grant. So it will recognize revenue at that point, and it will recognize a receivable, and then at some point in the future it will get the payment. However, sometimes payment is received first. So the grantor provides the government with the money before the government has done whatever it needs to do to be eligible for that. And as long as it hasn't met its eligibility requirements, when it recognizes the cash that it's received, it's going to recognize an offsetting liability, because technically it's supposed to return that money if it never meets the requirements, which probably mean spending on the particular program that the grant is for. If all of the eligibility requirements have been met, cash is received in advance, maybe there were no eligibility requirements, or there were and they've been met by the government, but there's also a time restriction, meaning they're not allowed to use the money until some point in the future, next year or the year after. If that's the case, then when the government recognizes the cash it's received from the grant, it's going to recognize a deferred inflow of resources to offset it. So the reason it doesn't recognize a liability is because it doesn't have to give that money back. It's already met any eligibility requirements if they existed. So it's entitled to that money now. But there's a limitation that says you can't spend it this year. You can't spend it until next year. So when next year arrives, they can eliminate the deferred inflow and at that point recognize the revenue. Now, if a government is a provider of grants, so they're on the flip side of it, then there's a really nice parallel here in the accounting. So if they're the provider and they provide the grant in advance and the recipient hasn't yet met the eligibility requirements, then the provider recognizes an asset, a grant provided in advance, and then when the eligibility requirements are met, the asset is removed and it recognizes grant expense at that point. If it's a situation where only a time requirement exists and there are no remaining or never were any eligibility requirements, then the provider is going to recognize a deferred outflow of resources, and when that future period arrives under the time restriction, at that point eliminate the deferred outflow of resources and recognize grant expense at that point. Debt issuance costs are an example of finding out that something that was being reported as an asset on the books, in fact, wasn't an asset, wasn't a deferred outflow of resources, was actually a current period of outflow of resources. So other than prepaid insurance costs, all other debt issuance costs should be recognized as an outflow of resources in the period in which they're incurred, probably when the debt is issued. So that's when they should be reporting an expense or an expenditure. Prepaid insurance, like any prepayment, should be reported as an asset. It already was before. Under Statement 65, it continues to be reported as an asset, like prepaid rent or prepaid subscriptions. In Gatsby Statement 48, which deals with the sales of future revenues, if a government receives proceeds from the sale of the revenues up front, it should report that as a deferred outflow of resources and then recognize the revenue from it over the period during which those future revenues are actually collected. I'm not going to get into the intra-entity transfers here because now we're really starting to get into some inside baseball. But if you take a look at the required readings about Statement 65, you'll see a little bit more information in there. Debt refundings, used to be, reported as, as losses and gains that were hung on the balance sheet and then amortized over the life of the debt, or the older the new debt, whichever was shorter. Instead, because they were never assets or liabilities. If there's a loss on the refunding of the debt, it should be a deferred outflow of resources. If there's a gain, it should be a deferred inflow. And then that deferred outflow or inflow will be amortized over the shorter of the life of the old debt or the new debt. The same is true if there's a refunding of a lease. If there's a loss on a refunding of a lease by changing the terms of the lease with the lessor, then a loss would be a deferred outflow, a gain would be a deferred inflow of resources, and then recognized over the shorter of the old lease or the new lease. Now, in a way, regulated operations like rate-regulated public electric utilities have been reporting deferrals for a very long time. They've been called regulatory assets and regulatory liabilities. I won't get into too much detail because this could be a lecture all on its own. But suffice it to say that when an entity has its ability to set rates for customers heavily regulated, those regulators are looking at the finances of the government, that governmental entity, looking forward and saying, okay, we're going to approve rate increases of X amount based upon your finances, and that's a guaranteed increase, and so in a sense that qualifies as being an asset. Whereas if they determine that the entity, the electric utility, should be returning some money to its customers, then it will have them recognize a regulatory liability because it is definitely going to have to make those repayments because the regulator has said they have to. Those things really are deferred inflows and deferred outflows rather than assets and liabilities, and that's the way they will be reported going forward. But that's really what they've always been. And they've always been at least identified as their own thing, although not presented separately from the assets and the liabilities. In the governmental funds, as you know, in order to recognize an inflow of resources as revenue, in addition to being measurable, it needs to be available, which is something that isn't required for accrual. It's only required under modified accrual. And that means it's collected during the year or soon enough thereafter that it can be used to finance current period expenditures. In the past, unavailable revenue, meaning revenue that isn't going to be collected until after the period of availability, after the end of the year, for instance, 60 days for property taxes beyond fiscal year end, if it was going to be collected in day 61 or later, it would be reported as a liability and called deferred revenue. Under Statement 65, that should be reported as a deferred inflow of resources until the revenue becomes available at some point in the next year when it's actually collected in all likelihood. That should never have been a liability, but there really was nowhere else to report it because it's not an amount that has to be repaid. It's already been received, the government was entitled to it, but because of the requirements for modified accrual, it couldn't yet recognize it as revenue because it wasn't available. So again, you're just deferring the recognition of that inflow of resources as revenue until the inflow actually becomes available. I mentioned prepayments as an example of things that had not changed. I also, in talking about the government grants, gave you the examples where the grant was received in advance, but there were eligibility requirements that still hadn't been met. Those were already reported as liabilities and assets by the recipient and provider, respectively, and they will continue to be reported in that manner. Resources that are received in advance of an exchange transaction, so that's a prepayment from the other side. Someone has prepaid the government for something, so the government has a liability until it actually does what it's required to do, and then once it does, it can recognize that as revenue. But until then, it has to, it's liable to repay that money to the provider.
Something else that is affected by the reporting of deferrals is the determination of what governmental and enterprise funds are required to be reported as major under GASB Statement 34 and therefore reported on the face of the financial statements in their own column.
As you will recall, if assets or liabilities or revenues or expenditures or expenses were equal to 10% of the total for all funds of that category or type, so for all governmental funds or for all enterprise funds, and that same element was greater than or equal to 5% for all governmental and enterprise funds combined, then it was required to be reported as a major fund and therefore shown in its own column on the face of the governmental fund or enterprise fund financial statements. What has changed here, essentially is that some of those things that were assets are now deferred outflows. So, and some of the liabilities are now deferred inflows. So you're going to combine those assets and liabilities, or assets and deferred outflows, or liabilities and deferred inflows, for the purpose of doing this calculation. There are some things like bond issuance costs that are not even deferrals now; they're current period inflows and outflows. So that may affect some of the major funds. There might be one that made it in based on expenses or expenditures, and because, or maybe it didn't make it in, and now you've added this current period expense or expenditure related to debt issuance costs, which might push it into the into that realm. Or things that were assets and liabilities that are now current period inflows or outflows, and now it qualified under assets or liabilities before, and now it doesn't. That isn't likely to happen very often. It would really have to be the rare instance in which they were really right on the margin, and this change made the difference. I don't think it will really have that much impact, and in fact, I haven't seen very much impact from the implementation of 65 on the reporting of major funds. One other thing that Statement 65 says is that the use of deferred should only be used in talking about deferred inflows and deferred outflows of resources, and that none of these new deferrals that are being reported should have the word deferred in them. To move away from the use of the term deferred revenue, most notably, which meant a whole bunch of different things and included both liabilities and deferred inflows of resources.
That brings us to the end of the presentation on deferrals. If you've done the readings and you've made it through this interminable presentation on deferrals, you should have a much better understanding of what they are and why they're reported and what statements 63 and 65 require. If you have any questions, of course, you can email them to me or post them on the course website so that everyone can benefit from the answers, and I would obviously be very happy to answer them for you. Thank you very much for your attention.